Over the past several months, several major voices in finance have begun highlighting shifts in the global economy. These aren't dramatic predictions, they're careful observations about trends that could matter in the years ahead. One person who recently went viral for discussing these long-term risks is Dalio, especially when he explained why he fears something worse than a recession.
I think that right now we are at a decision-making point and very close to a recession. And I'm worried about something worse than a recession if this isn't handled well.
After hearing that, the timing of what the Bank of England has just revealed becomes even more relevant, and we'll come back to Dalio's warning later on. The United Kingdom has just been hit with one of the most serious financial warnings issued in years, one that most people will never hear about, and one that could shape the next decade of the global economy. The Bank of England has quietly sounded the alarm that the world may now be entering a full-scale AI bubble, one driven not only by soaring excitement about artificial intelligence, but by something far more dangerous: trillions of pounds of debt tethered directly to the sector. It's a warning that echoes the early 2000s dot-com boom and the financial engineering that helped trigger the 2008 crash. And in the bank's own words, this combination could upend the credit markets. That means banks, hedge funds, governments, and global markets, including the UK, could all feel the shockwaves if the bubble bursts. The warning begins with a simple fact. The world's biggest technology companies are preparing to spend $5 trillion on AI infrastructure over the next 5 years. That is one of the biggest investment commitments in modern economic history. We're talking about data centuries, chips, cloud computing, supercomputers, generating AI models, energy systems, and entire new corporate divisions built around artificial intelligence. The scale is unprecedented. But what makes this different from previous tech cycles is that companies are not paying for all of this out of profit. According to the Bank of England, roughly half of the $5 trillion investment, around $2.5 trillion, will be funded with debt. That means borrowed money, loans, bonds, highly leveraged financing, and that instantly ties the fate of the AI sector to the global credit system. This could prove dangerous if investor sentiment towards AI changes and the sector is hit by a sellout. On some measures, equal valuations in the US are approaching levels not seen since the dot-com bubble, and in the UK and EU, not seen since the global financial crisis, Andrew Bailey, the bank's governor, said. The AI sector is a particular hotspot. He was speaking as the bank released its latest assessment of the UK's financial stability, in which it cut capital requirements on the banks for the first time since the 2008 crash, cautioned that gilt-related leverage borrowing by hedge funds had reached almost £100 billion, warned that risks to Britain's financial stability had risen this year. The market euphoria for AI is one of the drivers of these risks. While the bank said 2 months ago that rising valuations of US tech companies risking creating an AI bubble, it signaled that the use of debt by the industry was a new concern. The role of debt financing in the AI sector is increasing quickly as AI-focused firms seek large-scale infrastructure investment, it said. By some industry estimates, AI infrastructure spending over the next 5 years could exceed $5 trillion. While very large technology companies, widely referred to as the hyperscalers, will continue to fund much of their operating cash flows. Approximately half is expected to be financed externally, mostly through debt. The central bank explains it in the simplest possible terms. AI hype plus massive borrowing equals instability, because if AI stock prices fall, all that borrowed money becomes a potential bomb inside the financial system. Think of it this way. Imagine a company borrows billions to expand its AI division under the assumption that future profits will be huge. But what if those profits don't materialize? What if the competition intensifies? What if regulations slow adoption? What if the current hype fades? Suddenly, that debt becomes much harder to repay. Multiply that risk across hundreds of firms around the world, and lenders, including banks, hedge funds, pension funds, and investment firms, could collectively suffer enormous losses. Losses that spill over into the wider economy. The Bank of England says this is exactly what could happen if AI stocks experience a sharp correction, and the timing matters. The bank points out that valuations today look eerily similar to valuations last seen in two of the world's biggest bubbles, the dot-com bubble of the early 2000s and the run-up to the 2008 global financial crisis. In both cases, markets were driven by extreme optimism, first about the internet and then about housing, and both times debt amplified the damage when confidence collapsed. The bank is now suggesting that the current AI boom is beginning to show the same hallmarks: soaring stock prices, massive corporate borrowing, and investors assuming that future profits will be enormous and guaranteed. While Britain's benchmark FTSE 100 stock index has relatively little direct exposure to AI, the UK market could nevertheless be caught in the spillover from a sell-off. If the US AI companies account for 44% of the market capitalization of the S&P 500 index, up from 26% in 2022, the bank said. They also drove 67% of the year-to-date returns by the American index, which includes Nvidia, the maker of chips that are integral to AI as a constituent. In other words, the US market is no longer being lifted by broad economic strength. It is one being lifted by one single sector, a sector the Bank of England believes is overheating. This matters enormously for the United Kingdom. Even though the UK stock market has relatively little direct exposure to the AI companies, the bank notes that the UK markets can still be dragged down if the US experiences a big sell-off. As the old saying goes, when America sneezes, the world catches a cold. And that isn't just a cliche, it's economic reality. The United States still sits at the center of the global financial system. It remains the world's largest economy, meaning its financial moves create ripple effects that spread across continents. The US dollar is the world's reserve currency, used in global trade, energy markets, international loans, and central bank reserves. When the dollar moves, the world adjusts. On top of that, global markets react instantly to US interest rates, job data, and financial shocks. A single Federal Reserve announcement can move stock markets from London to Tokyo. A weak US jobs report can shake investor confidence worldwide. And when Wall Street sells off, it often forces funds, banks, and pension giants to rebalance portfolios across multiple countries, including the United Kingdom. This is why a major correction in America's AI sector wouldn't stay in America. If AI stocks fall in the US, there is a high chance that UK equities, credit markets, and even the pound could feel the impact. The Bank of England didn't stop there. In the latest financial stability report, it warned of another problem building in the shadows. Hedge funds have now taken on £100 billion in leveraged borrowing linked to the UK gilts. That's a massive amount of embedded risk. These funds are borrowing heavily to bet on government bonds, positions that could unwind fast if market conditions shift. Combine that with trillions of dollars of AI-related debt, and the scale of the bank's concern becomes clear. Governor Andrew Bailey called this a serious financial stability risk. He warned that losses on lending to AI companies could ripple through the banking system, especially if large amounts of debt become unprofitable or impossible to repay. And although UK banks have passed stress tests and are far stronger than in 2008, the danger goes beyond banks. It's about the entire global financial structure, credit markets, sovereign debt, tech valuations, and geopolitical pressures. In a world this interconnected, one shock can travel everywhere. The warning grows sharper when you factor in geopolitics. Tensions between the US and China are rising, trade is fragmenting, supply chains are shifting. Governments worldwide are borrowing at record levels. The global economy is already stretched and fragile. One sudden shift in sentiment could trigger a chain reaction. Add a potential AI bubble to this environment and the risks start multiplying. This is why Bailey compared today's valuations to the dot-com era. Investors believed the internet would change everything, and they were right. But markets got ahead of reality. Companies with no profits or viable models saw their stock prices explode, only to collapse when the bubble burst, wiping out trillions. The bank suggests a similar pattern may be forming around AI. Yes, AI will transform industries. Yes, giants like Nvidia, Microsoft, Google, and Amazon are building world-changing technology. But that doesn't mean every AI stock deserves sky-high valuations, or that companies should borrow trillions to chase growth at any cost. A clear example of this is OpenAI, the company headed by Sam Altman. The cost of its computer commitment, the AI infrastructure such as chips and servers that power its world-famous chatbot, is $1.4 trillion over the next 8 years, a figure that dwarfs its $13 billion in annual revenues. Over the past week, this gap has appeared chasm-like, becoming a backdrop to market nerves over AI spending and statements by OpenAI executives that did little to answer concerns. The truth is, this level of spending is not financially sustainable, not under any conventional definition of healthy business models. When a company projects $13 billion in annual revenue, but commits to $1.4 trillion in infrastructure costs, the gap isn't just large, it's mathematically impossible to bridge without extraordinary intervention. No business can organically grow its way into covering 100 years' worth of expenses in less than a decade. The only way this model survives is through endless waves of external financing, new investors, new loans, new debt instruments, and the assumption that future profits will also be enormous, that today's losses won't matter. That is exactly the type of thinking that inflated the dot-com bubble and the 2008 housing bubble. OpenAI, like many AI-focused firms, is being financed on the belief that AI will rewrite the global economy. But belief is not cash flow. If AI adoption slows, if completion intensifies, or if regulators step in, the projected revenue growth collapses while the debt remains. And once debt becomes unpayable, it becomes destabilizing. This is why the Bank of England is warning so forcefully the financial architecture being built around AI relies on optimism, not on proven returns, and optimism alone cannot service trillions in borrowing. This brings us to the most important and most underreported part of the Bank of England's warning, the role of debt. The bank says AI firms are relying more and more on external financing. They aren't funding this boom solely from their profits. They are issuing debt, taking loans, raising capital through credit markets. That means banks and lenders are now holding a huge amount of exposure tied directly to AI companies. If the bubble bursts, many of those lenders could face losses. And if lenders face losses, they may pull back from lending entirely. That can create a credit squeeze. A credit squeeze slows business investment. Slower business investment slows growth. And slowing growth, combined with major market stress, can push economies into recession. But the Bank of England goes even further. It warns that this isn't just about recession, it's about systemic risk. It's about the possibility that losses in the AI sector could ripple through the world's financial systems in ways that are unpredictable and potentially severe. And this is exactly where the warning connects with what billionaire investor Ray Dalio, the founder of Bridgewater Associates, the world's largest hedge fund, has been warning about. In an earlier interview this year, Dalio said the United States is not just close to a recession, it is close to something worse than a recession. To be clear, Dalio was not talking about a specific industry or a single event. He was speaking about the overall state of the American and global economy and how multiple long-term pressures are converging at the same time. Dalio is one of the most respected economic thinkers alive today, famous for correctly predicting the 2008 financial crisis. His warning is built on decades of studying economic history and what he calls the big cycles that drive the rise and fall of nations. According to Dalio, 5 historic forces tend to reshape global systems: excessive debt, internal political division, geopolitical conflict between major powers, large-scale natural or external shocks, and rapid technological disruption. Dalio's concern is that all 5 of these forces are intensifying simultaneously, creating pressure not just on markets, but on the stability of the entire economic order.
I think that right now we are at a decision-making point and very close to a recession. And I'm worried about something worse than a recession if this isn't handled well. A recession is 2 negative quarters of GDP, and whether it goes slightly there, we always have those things. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order because we cannot spend the amounts of money, so we have that problem. And when we talk about the dollar and we talk about tariffs, we have that. We are having profound changes in our domestic order, how ruling is existing, and we're having profound changes in the world order. Such times are very much like the 1930s. I've studied history, and this repeats over and over again. So if you take tariffs, if you take debt, if you take the rising power challenging the existing power, if you take those factors and look at the factors, those changes in the orders, the systems, are very, very disruptive. How that's handled could produce something that is much worse than a recession, or it could be handled well.
The most alarming part of Dalio's argument is his claim that the monetary order itself, the global system that supports currencies, trade, and financial stability, is weakening. He argues that the United States cannot continue issuing unlimited debt without consequence. Eventually, there will be more debt than the world can absorb. And when the confidence in government debt weakens, currencies weaken. When currencies weaken, markets destabilize. And when markets destabilize, political and geopolitical tensions accelerate. Dalio describes this as a pattern seen repeatedly through history, one that often precedes large-scale economic dislocations. And here's where the Bank of England's AI warning fits perfectly with Dalio's framework. The AI bubble adds trillions of pounds of new debt into a global financial system that Dalio already believes is stretched to the edge. This means the AI boom is not just a tech story, it is a credit story, a monetary story, a systemic risk story. If the AI bubble bursts, it could become the exact type of shock that Dalio warns could tip the world from a normal recession into something far worse. A breakdown in confidence, rising financial instability, and deeper economic pain. Dalio's point is simple. Recessions come and go, but systemic breakdowns like the 1930s or the 1970s or the 2008 crisis leave lasting scars. In Dalio's own words, what he fears most is the value of money. Collapsing political conflict rising beyond normal democratic debate and international tensions triggering severe economic or military conflict. And what creates these conditions? A highly leveraged, highly fragile financial system stacked on top of debt-driven bubbles. That is why the idea of an AI bubble is so concerning. Because if it bursts, it doesn't burst in isolation. It bursts on top of record government debt. It bursts on top of global political instability. It bursts on top of deep divisions between nations. And it bursts on top of a financial system already struggling with inflation, interest rates, and volatility. Returning to the Bank of England's warning, the bank makes it very clear that even though the UK is not as heavily invested in the AI stocks as the US, it is far from safe. The UK is deeply integrated into global markets. British pension funds hold US equities. British banks lend to global tech companies. Hedge funds based in London trade US assets. The City of London is one of the world's core financial hubs. And when the world's financial system shakes, London feels it. The bank also notes that while UK banks are resilient, the real risks come from non-bank lenders, institutions that are large, heavily leveraged, and often lightly regulated. Think hedge funds, private equity funds, shadow banking equities, and overseas institutions. These players can move markets quickly. They can rapidly unwind positions, and they can create massive momentum-driven swings in markets. If AI stocks crash and these institutions start selling assets or unwinding debt positions, markets everywhere could be forced into a sharp correction. Let us know what you think in the comments below, and don't forget to like, follow, and subscribe.